For nearly a century, one single book has really stood out as the ultimate guide to the financial markets. And it's not about hot stock tips or some kind of secret formula. Nope, it's about a philosophy. Today, we are going to break down the absolutely timeless wisdom of Benjamin Graham's masterpiece, The Intelligent Investor.
So this thing was first published way back in 1949, and people often call it the Bible of value investing. And for good reason. Its author, the legendary Benjamin Graham, didn't just survive the 1929 crash, he actually built an entire system based on what he learned from it, and he'd go on to mentor some of the greatest financial minds we have ever seen.
And his most famous student? Well, that was a young guy named Warren Buffett. Buffett says that finding this book was one of the luckiest moments of his life, and he calls it, quote, by far the best book on investing ever written. I mean, that's a pretty powerful endorsement, right?
And that really brings us to the core question here. Graham's title, The Intelligent Investor, is very, very deliberate. He draws this sharp line in the sand about what it actually means to be intelligent when it comes to finance. So what's the secret? Well, let's dive in and break it down.
Okay, so to get started, we really need to understand the problem that Graham was trying to solve in the first place, the wild, often completely maddening nature of the stock market itself. I love this quote because it just perfectly captures Graham's view. See, he didn't see the market as some kind of rational calculator, not at all. He saw it as a moody, manic-depressive business partner, swinging from these irrational highs to completely panicked lows. Now, for most people, that's terrifying, but for Graham, that was where the opportunity was.
And that is Graham's whole purpose here. He is not selling you a get-rich-quick scheme. He's offering a mental framework, a way of thinking to protect you from the market's emotional chaos, and, just as importantly, to protect you from your own emotional reactions. So this all kicks off with one really fundamental question Graham forces every single one of his readers to ask themselves. Are you an investor or are you a speculator? Graham's biggest beef was that Wall Street had totally blurred this line. For him, it's simple. An investor buys a piece of a real business. They analyze its value, its operations, its financial health. A speculator, on the other hand, is just gambling on which way the stock ticker is going to move without any real regard for the actual business behind it. So Graham gave us this crystal clear definition. An investment has three parts. 1, it requires thorough analysis. 2, it promises safety for your initial capital. And 3, it offers a satisfactory, notice he says satisfactory, not spectacular, return. If your plan doesn't meet all three of those criteria, he's blunt about it. You're not investing, you're speculating.
Now, to help us deal with the market's wild swings, Graham came up with this simple but absolutely brilliant little story. It's one of the most famous allegories in all of finance, and for a really good reason. It's time to meet Mr. Market.
So here's how the story goes. Imagine you own a piece of a business, and you have a partner named Mr. Market. Now, he's a great guy, very helpful, but he's also, well, he's very moody. Every single day, he shows up and offers to either buy your shares from you or sell you his. The catch? The price he quotes is based completely on how he's feeling that day. On his good days, he is just euphoric. He sees nothing but sunshine and rainbows ahead, and he'll offer to buy you out at a price that is just completely disconnected from the company's actual value. He's basically offering you a huge, irrational profit on a silver platter.
But on his bad days, oh boy, he is terrified. He's convinced that business is doomed, the world is ending, and in a total fit of panic, he'll offer to sell you his stake for pennies on the dollar, giving you the chance to buy more of the business at an absolute bargain basement price.
And here's the absolute genius of it all. You never, ever have to trade with him. You can just ignore his crazy offers completely. Or you can take advantage of them. You sell to him when he's euphoric and buy from him when he's panicked. His mood is your opportunity. But the key is you can't let his mood become your mood. You are the one in control.
This whole idea of Mr. Market leads us directly to the bedrock of Graham's entire philosophy, the single most important concept in the whole book. He called it the ultimate safety net for any investor.
To really get this, let's look at a real-world example from Graham's own career. He found this company, Northern Pipeline Co., and it was trading for $65 a share. But after he dug into their books, he discovered the company held at least $80 per share in high-quality bonds alone. The market price was way below the company's easily verifiable worth. And that gap between price and value is everything.
That gap is what Graham called the margin of safety. It's the buffer between the price you pay and the value you get.
You can think of it as the principle of buying $1 for 50 cents. And this discount, it doesn't just give you a chance for profit. More importantly, it gives you protection against bad luck, miscalculations, or just a random downturn in the economy.
Seriously, Graham believed the entire secret to sound investing could be boiled down to just these 3 words. If you remember nothing else from our little chat today, remember this: margin of safety. It is the absolute central pillar of his entire philosophy.
And think about the freedom this gives you as an investor. If your margin of safety is big enough, you don't need a crystal ball. You don't have to perfectly predict what the future holds. The business can stumble, the economy can dip, and that margin of safety is there, acting like a cushion to absorb the shock and protect your investment.
So how do you actually put all this into practice? Well, Graham knew that not everybody's the same. He was a practical guy, so he laid out 2 very distinct paths for investors to follow.
He outlined 2 main paths. First up is the defensive investor. This person values simplicity, they want to avoid constant effort, and their goal is a solid, steady portfolio. Then you have the enterprising investor. This is the person who's willing to put in the time and the homework to really hunt for those deep bargain opportunities. The most important thing, Graham says, is to be honest with yourself about which one you are and then stick to that strategy.
And this brings us right back to the title of the book, because being an intelligent investor has absolutely nothing to do with your IQ. Graham says it himself, it's a trait more of the character than of the brain. It's all about having the emotional discipline to be patient when everyone else is greedy and to be brave when everyone else is fearful.
And this, right here, might be the most important lesson in the entire book. Your biggest enemy in investing isn't a bad economy or a bear market. It's you. Real long-term success comes from mastering your own behavior, not from trying to outsmart the market.
In the end, all of Graham's wisdom leaves us with a pretty simple challenge. Look, we can't control the market, but we can control ourselves. So the real question isn't what the market is going to do next. It's about what you are going to do. How will you choose to behave?